Australia's housing crisis is facing a new pressure point. The US-led war in Iran is pushing up global energy prices, driving construction costs higher and making it harder to build new homes. At the same time, Cotality data shows that home values in Sydney and Melbourne are now falling as higher fuel prices and rising interest rates weigh on buyers. Let's get more now with Nerida Conisbee, who's a chief economist at real estate group Array. She's also the chair of the Australian Construction Forecasting Council. Nerida, great to have you with us. And to be fair, we are also going into what is a seasonally slower time of year, going into winter for the property market. But are you seeing signals that are perhaps atypical, even with seasonal impact taken into account?
Yeah, look, we absolutely are. I mean, we have started to see prices moderate in bigger cities, so particularly Sydney and Melbourne, and particularly the top end of the Sydney and Melbourne markets. But we're also seeing quite different behaviour at open for inspection. So we track open for inspections every day. So we see around 12,000 per week. When we have a look at the number of people attending open homes, it has clearly moderated compared to where we were even a few months ago.
What do you put that down to? Is it fair to assign some of the blame to a war that's taking place almost 13,000 kilometres away?
Yeah, look, it is. I mean, if you have a look at consumer sentiment at the moment in Australia, it is now at record lows. So ANZ have been tracking it since 1973 and they've never seen it so low. So clearly rising fuel prices is having an impact on how people feel. And it is a very visible impact because, you know, people can drive down the road and they can clearly see how much prices have risen. It does flow through to housing, and I think it is partly that. So partly the fact that people are feeling quite different to how they were feeling before the conflict. But we have also had 2 interest rate hikes, so that obviously does also impact sentiment, particularly in really expensive markets like Sydney.
I was going to say, I mean, how are you expecting, how much more downside are you expecting in the premium markets?
Yeah, the premium markets have really been struggling, particularly in Sydney. So if you have a look at Sydney over the past 12 months, prices have grown by about 7%. So they're still moving quite quickly. But we're seeing quite different behaviour at the cheaper end of the market compared to the more expensive end. So when we have a look at the bottom 25th percentile, prices are moving sort of 12, 13%. They're really being buoyed by very generous first home buyer incentives, a lack of building, all of those factors are flowing through. When we have a look at the top end of the market, which, you know, you're looking at sort of 4 million plus, much different behaviour. So buyers are more cautious. We're not seeing so many attending open homes. We often think of people that are buying these homes as not relying on mortgage debt, but in a city like Sydney, because it is so expensive, people do have very large mortgages. So clearly any increase in interest rates is going to have a big impact. Very different conditions, though, when we have a look at places like Brisbane, Gold Coast, Sydney. Gold Coast in particular now, the median has hit 1.4 million. So the median's doubled over the past 5 years, and really the top end is driving it. There's just very, very high demand for premium property in southeast Queensland at the moment.
Yeah, when it comes to those mid-sized cities, for example, at what point do you expect affordability to start capping the growth there?
Yeah, we do think, well, I mean, it is an interesting one because when you have a look at somewhere like Gold Coast, we have almost seen affordable properties dry up. So over the past 12 months, we've only seen around 300 properties sell for under $750,000. So very, very different behaviour compared to what we were seeing 5 years ago when, you know, almost the majority of homes were selling at that price point. We do expect affordability to impact those markets, but really when we have a look at what the impact of the 5% deposit scheme, so the scheme provides first home buyers with the ability to go in and buy a home with only a 5% deposit. It has really accelerated the cheaper end of the market as a result, and we haven't been able to keep up with supply. So that's a big problem in Australia at the moment. When we have a look at the level of construction taking place, there has been very little taking place, and as a result, we are seeing these price escalations across the country.
Nerida, there is an expectation that once we get the May budget that there will be a centrepiece around returning to the pre-1999 1099 way of taxing capital gains. What do you make of this? And do you think with your modelling, is that going to make a meaningful impact when it comes to dampening investor confidence and enthusiasm?
Yeah, look, it will. I mean, when we have a look at a good case study is looking at Victoria. So in Victoria, it is a very heavily taxed state at the moment, particularly for people that are investing in property. So not just residential property, but also commercial property. And what we have seen there is a pullback in the number of people buying investment properties. So when we have a look at between 2023 and 2024, we saw a significant decline in the number of rental properties available. So we can clearly see that when we do make it, we put in taxation or make taxation reform that's adverse to investors, that they do pull back pretty quickly. Capital gains tax concessions, we're not quite sure exactly what the changes will be made. Similarly, negative gearing, the rumour is that it will be restricted to only 2 properties. Obviously, that will also make an impact in terms of investor activity. So, and then we have those 2 interest rate rises. So we have seen investor activity pull back already this year. The flow on is obviously very negative to renters. And when we have a look at Melbourne in particular, we have seen rental growth significantly outpace price growth as a result of those increasing taxes on investors.
Then there's, of course, the element of whether there's going to be grandfathering or not for those policy changes. Do you think ultimately, we've already seen the impact, right, when it comes to the impact on intergenerational equity, as the Treasurer would refer to it as. Do you think going forward it could make really a meaningful impact on how the property market is structured in Australia?
Yeah, so what we're seeing, again, coming back to Victoria, what we have seen is that when you don't increase supply, or supply doesn't keep pace with the level of population growth, when we start to change tax policy, you shift the growth from prices to rents, and that's clearly what we've seen. So in terms of younger people, if we do start to make significant changes to tax policy for investors, it will slow price growth. We know that level of demand will pull back, so that ultimately is a benefit for home buyers. Probably though, the flip side is that it's not great for renters, and in Australia we have seen the highest growth in rents that we've ever seen over the past 5 years, pretty much since the start of the pandemic. So on one hand, it will make it great for the younger people that want to buy a home, but not necessarily people that are renting. And I think that's a real challenge at the moment. If we don't meaningfully address supply, we're not making a wholesale improvement to affordability.
Nerida, always great to chat with you. Nerida Conisbee, who's the Chief Economist at Ray White. We have more on Australia Ahead every Tuesday at 10:40am if you're watching here in Sydney, 8:40am in Hong Kong. You can also tune into the Bloomberg Australia podcast, delving into the biggest stories shaping the country's role in global business. You can find that on Apple, Spotify or Bloomberg.com. More ahead on the Asia Trade. This is Bloomberg.